Hello and welcome to the Accent Podcast, where I, Asner Midov, interview accomplished investors, entrepreneurs, business and thought leaders about their personal and professional journeys. In this episode, I sit down with Michael Hoffmann, the co-founder and president of Probitas Partners, one of the best-known placement advisory firms. Since inception, Probitas has raised over $68 billion for both established and emerging investment managers. In this interview, we covered many topics, from the most popular private equity strategies to how to raise your first private equity fund, and from Michael's career path to his favorite song. But I'll let you listen for yourself. Michael, thank you very much for joining us and welcome to the podcast. So my plan is to discuss Probitas Partners, discuss placement firms and private equity industry, learn more about you and your career, and in the end of the interview, we'll have our traditional blitz. How does that sound?
Terrific.
Okay. Tell me, what's Probitas?
Probitas means with integrity, or in our client's best interest. Fidelity was taken when we were looking for names at the end of the tech bubble, so we chose that name and chose to make it mean something.
And what do you guys do?
Probitas is a placement agent, meaning that we raise private equity capital for private equity funds, real estate funds, infrastructure, and credit funds. So we identify what we think to be the best managers in any given space, regardless of geography, and then seek capital for those managers from institutions around the world.
And the way you guys make money is you charge the managers or you charge investors who hire those managers?
Yeah, our fee, unlike retail and other products, is actually paid by the fund manager, not by the investors in the fund.
Got it. And who are your typical clients and how do you acquire them?
We have two clients, right? In our perspective, we have one that's contractual, which are the fund managers. We meet with about 600 managers a year all over the world. We pick from them about 12 to 14 that we represent in any given year in all different strategies and geographies. Typically, 2 or 3 of those are repeat managers. So out of the 600, we usually only do 10 new pieces of business. So it's a pretty high bar. But our other clients are permanent clients, right? They're the institutions with whom we have relationships that ultimately invest in those funds to make them successful. And we treat them, notwithstanding a lack of a contractual arrangement, every bit like a fiduciary in terms of how we operate with them.
So somebody who is listening would think, if fund is really successful, has a great track record, why would they need placement agent?
No, really good question, right? A couple of answers. If you're a really successful fund, you've got more capital than time. So there's a time value benefit of more efficiently raising capital. There's also a benefit to raising capital from investors that you specifically target. So if you're that successful, you have the luxury of targeting new capital from Korea, greater foundations and endowment representation in your base. So you have the luxury of choosing who your investors might be. At the end of the day, the market changes a lot. There's probably a 10 to 20% turnover on average every year at institutions. So while you might know the University of X or pension fund for the state of Y, the likelihood is that the people every couple of years turn over. So unless you're in constant dialogue with the market of investors like we are, it's likely you won't be up to speed if you're a manager who comes back for a new fund every 3 to 4 years.
How hard it is to offer your services to LPs? Do they see the value?
I think it really depends. When we formed Probitas by design, we built a dedicated and independent research capability so that we were bringing them something of value inherently in all of our discussions and interactions. If you're only selling product, there's still a value, right? As a canary in the coal mine, right? You're not likely going to risk one of your 10 or 14 slots with a fund manager that's not of high quality that can be raised. So you're a reasonable proxy for quality in the marketplace. But I think beyond that, people in the investor seats want to have a better relationship of trust where you're candid and forthright with them on the weaknesses, the strengths of those funds, how it sits relative to the competitive market. So at the end of the day, if you've really built a quality relationship based on value add, you don't have to sell yourself any further. You've earned that right, but you have to earn it.
How do you choose those funds yourself? Do you have like certain criteria? I'm assuming track record is one of them, but what else?
No, track is essential, right? So again, if we're seeing 600, we have the luxury as an independent firm, right, not part of a larger institutional organization, to choose who we raise capital for. Track is certainly critical. Strategy relevant to what LPs are looking for in the next 12 to 18 is particularly important. So when we sit down with investors and have discussions uniquely in our market, not with the client in tow trying to sell something, but really understanding what investors like, don't like, what's up with their portfolio, what they personally like and don't like, all of those make us much better at understanding what the demand is for any given product. And we roll that forward. So everybody on our team has a vote, and effectively in our investment committee, we have an all hands meeting, and then we have a narrower MD vote. But at the end of the day, everyone has a right to chime in. And if there's objections or people aren't compelled by a proposition, there are lots of other funds we probably won't take it on. One of the non-quantifiable aspects is, frankly, whether or not we like the guys and gals that we're going to be spending 12 months of plane and train and back of the car time with. And it's consequential, right? Private equity is a unique asset where in the first 10 minutes of a meeting with an investor, I've got a pretty good sense whether or not we have a prospect. And it's not based on the numbers and a review of the data and understanding the strategy, because all of those things happen before that busy institutional investor said, I'll give you an hour to 2 of my time. At the end of the day, it's how compelling the presenter is. And it's not about how well they pitch. It's about whether or not they're trustworthy and warm, and there's a bond. There's a reason to want to spend more time. They went to school at the same place. They grew up in the same place. Their children enjoyed the same. Something that differentiates that proposition from the other 30 a month or more that all these institutional investors hear.
So it's very much a relationship-driven business, I guess.
Very much. One of the few, right, in the institutional marketplace still. If you think about it, right, you're knocking on someone's door saying, give me $50 million and I'll show up 10 to 12 years from now and hopefully return that capital and give you a return on it. And by the way, I can't show you what we're investing in, right, but I'll tell you a story about what we've done in the past and what we'll try to do again for you. So it's all about trust and integrity and confidence that that's a repeatable exercise. But it comes down to the person. Am I compelled that that guy or gal is going to do what they say they're going to do, right? And be passionate about it and execute it over the course of a decade to make me the returns that they're promising me.
So you're not necessarily working with the established funds only, right? You also help newer funds. How do you evaluate those people who have no track record and probably don't have much of a reputation?
Well, historically, over the last 15 years, about 40% of our funds have been first-time institutional raises. But I want to differentiate that. Typically, it's virtually impossible to institutionally raise a first-time fund without a track record. Mm-hmm. So the question really is not a track or not. They've got to have demonstrated investment acumen and capability in some capacity before. The question ultimately often is whether or not they have attribution for that track record, right? Under current SEC rules, you've got to have on 4 corners of a document someone signing off and giving you the right to use a track record that you don't own if you were an employee or a team member, but that fund manager does. So if the fund manager grants that attribution, investors will say, okay, I don't have to do a lot of new work calling transaction partners, attorneys, CEOs, and others to validate that track record. Far too much work for somebody who's already overstretched that makes a first-time fund really difficult. So without an attributable track record, we typically won't be able to successfully raise a first-time institutional fund.
So if I'm a big successful fund and I know that one of my employees wants to leave and start their own fund and compete with me essentially, why would I sign that paper that you just mentioned?
The attribution.
Correct.
It really depends. If that employee, right, was truly responsible for a number of the successes in the fund, when that manager goes back to market to raise their next fund, they're going to have to defend what happens now with the departure of a very important team member. So you have 2 paths. You can say, they were involved, but they weren't important, or they were partially involved, but they don't really have a right to claim attribution. And that's one path. And many managers take that rigid, dogmatic, we don't give attribution. The flip side is knowing that LPs are sophisticated and are going to call that departed employee and ask who did what at that shop, and knowing that that employee will still claim that they were responsible for those deals, even if they don't depict it in their offering materials, right, to comport with the SEC regs. There's still going to be a dialogue around it. So our role many times is helping with a détente situation that says, look, let's have shared attribution. Fund manager, why don't you give attribution saying that this departed employee was engaged and involved in these deals without being specific that they were the driving factor necessarily or 100% responsible, which is not typical. But let's have a shared attribution and an agreed message to the marketplace that allows both people to successfully raise capital.
So somebody who is currently working for the, Thoma Bravo or Vista, some of the big guys, and decides to start their own fund, should they just call you or what should they do?
Well, that's usually what happens. I mean, there are two avenues where really successful current employees that are either dissatisfied about where they're at in terms of opportunity to go forward, economics, or they have a burning desire to do what the guys who are leading the current fund that they're working for did before, and an entrepreneurial bent and want to explore that. Fund formation attorneys, right, are one of the first stops where they need to explore what their obligations are, what their liabilities are, and what's in the realm of possible. And then placement guys like us help them understand what the market's going to require and what the probability is to successfully raise the fund. So, a lot of meetings here in this room under cover of darkness over the last 10 years, right, from really successful, vibrant, talented guys and gals who are interested in raising their own fund, exploring what that looks like in a realistic perspective.
You've mentioned somewhere earlier that there are certain strategies that LPs might prefer. Do you see any specific strategies that in fashion right now?
Yeah, I mean, it ebbs and flows, which is what makes this job, so exciting, right? You see 600 managers that have different talents and strategies and skill sets, and you begin building trend lines from their activities. You see the same thing from institutional investors that are really quality, smart investors, and you can merge those two into what's likely going to come 12 to 18 months from now in terms of merging that demand with capability. There's a macro movement, certainly at the peak of a market. I think most people think that's where we're at, to look at more defensive strategies. There's a macro movement, especially with pension funds in the U.S., where you're no longer net intakers of contributions from employees, but now we're beginning to look at long-term distributions. So matching those liabilities with more secure, longer dated assets. So in that regard, you have things like timber 15 years ago. Today, farmland has taken off in terms of great interest because of the attributes being non-correlated, counter-cyclical, stable, with cap appreciation potential. So we're looking at things in that space. You see infrastructure finally in the U.S., right, because of those liability matchings, finally come into a bit more of a spotlight. Lots of allocations from investors here, but little has been deployed, and we see that finally changing. On the real estate front, you see people looking at more defensive strategies rather than more opportunistic shoot-the-moon strategies. Now, all those, I think, are indicative of both the capital market cycle that we're in, as well as a longer orientation toward matching liabilities with big institutions.
So now I want to learn a little bit about you, because you are one of the founders of the firm.
Right.
And I want to kind of understand your personality. Maybe I'll draw some parallels with other guests we've had in the past and going to have in the future. So tell me a little bit about where were you born and where you grew up.
Sure. I grew up in a small town in Wisconsin. So I was born in Oshkosh, Wisconsin. Everybody knows from the baby clothes, right? We moved about an hour from there into a town of about 3,000 people called Wapaka that was dominantly a farming and a foundry town. My dad was a lineman for a public utility. So when the lights went out because of ice storms or tornadoes or thunderstorms, he's the guy that would shimmy up the pole and turn your power back on over a 4-county area. So pretty tough job and pretty demanding job. But, at the end of the day, he'd set the standard for what was expected in terms of good behavior, taking care of other people, doing the right thing and working hard. And I think that kind of permeates my culture still today.
That's great. And were you the only child, or you have siblings?
Now I have 3 younger sisters, and they probably regret that to this day still. Right?
Yeah. And describe yourself as a child. Like, what was your personality like?
Well, you're probably too young to remember, but Dickies were all the rage, which were little make-believe mock sweaters that you wore underneath your shirts. Those and glasses, because I had eye issues early on, created what all my teachers dubbed the little professor. I was probably a pretty obnoxious kid, actually. I don't think I lacked for confidence. Oshkosh was really unique. Oshkosh had a university system where the professors taught in an experimental school that allowed a handful of kids to progress at their own pace within classes to the next level. So the professors starting off in a 4th and 5th grade environment would allow that group to advance as quickly as they wanted to. And the trade-off was that we had an obligation to mentor and to teach the rest of the students to try to bring them along on topics that they were, just struggling with and not moving as quickly. By the time we were our group of 8 into the 6th grade, we were working at junior and senior high school levels and stuff like physics that, frankly, today I don't think I could probably handle. But really exciting environment. And then we moved to a small town of 3,000 people that kind of dramatically changed the environment, as you can imagine.
Was it the more standardized school?
Very much. Yeah, very much. I finished high school when I was sophomore, and I came back and excitedly told my parents, because I was the school board representative, that I'd negotiated for early graduation. And I was 14. I was going to go to Madison, where I ultimately went to school. And they said, congratulations, but you didn't talk to us. And the answer is, it's not going to happen, to my great chagrin. So I ended up having a lot of jobs in high school. I was the assistant news director at the radio station. I was an editor for a 5-county paper. I announced at all the sports events and games. So I had a great time and did a lot of charitable things with Special Olympics that were really fulfilling, but it gave me access to much older peers. So I was typically dealing with college graduates in those positions, and really enjoyed that expansion right in a small town, being kind of part of that clique.
It seems like your degree was in English, sociology, and political science.
Unfortunately, yeah, it shows a lack of focus, which continues to be a problem today.
And how did you choose those?
I don't know. It was really interesting. I had an English teacher in high school who was a university professor, and she retired to my hometown, who had a really profound impact. She was brilliant, and she really drove advanced level thinking within a high school setting that I think obviously brought me into the English. The other degrees were just interesting. The stats function of sociology, the numbers orientation became really interesting. And political science was kind of inherently always of interest. So honestly, in the absence of any real direction, I didn't choose any one of them. So I ended up finishing all of them.
Obviously, yeah. Did you know what you want to be when you grew up?
I think there was always an aspiration, I think, to go to law school and to practice law. In a small town, many of the successful players were attorneys that turned business people, or bankers that were attorneys in prior lives. That kind of established a pathway that seemed like a rational one when I was 15, looking for what came next.
I think it was University of Wisconsin where you received your bachelor's degree, right?
That's right.
And then you went to MBA and JD, right? And also from University of Wisconsin.
Unfortunately, they didn't have a combined degree because I'm an old guy. So it was a
two separate
3-year law degree and a 2.5-year really challenging real estate degree. It continues to be the number one program in the U.S. for real estate. And, my major professor was a guy named James Grasskamp, who was a quadriplegic. So he got a football scholarship to Marquette University, brilliant guy. And literally 3 months into the season is impacted with polio, loses use of arms and legs, and kind of everything goes to his mind. He developed the Urban Land School of Economics, which is real estate. And literally in the late 60s built the first ever cash flow model that all of us are saddled with still today, using a rubber tipped eraser and a wooden spoon and punch cards on a computer. Seriously. Whenever I was really frustrated on his grading, and he hated lawyers, so that was an easy target, I'd walk into his room, and this guy worked so hard, notwithstanding his handicap. I had enormous respect, and I always ended up backing out of the room a little embarrassed that I was going to go complain about something.
And what was your first job after the graduation?
I had worked all the way through school as a house fellow in the dorms, and then I was working as an attorney in a law firm. Ultimately, my first full-time job was working for a real estate law firm in Dallas at the peak of the real estate boom, which was...
Was it 91 or what was it?
No, mid-'80s.
Mid-'80s?
I wish.
Oh, it's was it this
the RTC.
Savings banks jumped into the real estate and screwed it over?
Exactly.
I don't remember that part, but again, I read it. It's interesting. So you were in the middle of that.
Well, I was in the apex ride up and the crash down. So within a 3-year span, I saw a 12-year typical cycle. in Dallas, and I'd moved from one law firm to another to join a company called Trammell Crow, which is one of the biggest real estate players. We went in and took over the 5 largest S&Ls at the beginning of the S&L crisis. Literally, the CEO's 80-year-old father was shoveling documents into a furnace in the basement when we walked in with the marshals to take over the assets. I mean, an exciting time in retrospect, but literally a 15-year education in a 3-year span. So it was pretty exciting.
So that was your first job, you said, right? What
right.
did you do after that?
So I migrated to California with another law firm in Southern California, another real estate law firm. One of their clients was, at that point, a tiny company with 4 employees called AMB, which today is Prologis, the largest logistics industrial owner in the planet. Phenomenal job and really great people. But they convinced me to give up my legal practice, move from La Jolla to San Francisco, where the rent was twice as much. They pay me half as much, and I could start all over in a new career. But best decision I ever made, right? Really terrifically talented team, and ultimately migrated from a developer, institutional manager wannabe to one of the strongest players in the real estate market today.
How you transition from real estate to Credit Suisse first boss?
Well, my partner Greg and I, who were 2 of the 3 founders, had a real estate background, and DLJ at the time was looking for people who could sell real estate funds, because at the end of the RTC, the end of the meltdown with all of the savings and loans, a lot of fund managers like Apollo and others had built great machines to manage assets and invest in assets, but the distress was gone. So they needed to backfill it and created ultimately today's opportunistic real estate funds at the end of that cycle. Greg and I had experience on the real estate front, and they were seeking people who could sell private equity and real estate. So they recruited us at that stage.
That makes sense. Seems like you did fine back then. And then one day you guys realized that you want to do something different.
Well, the merger of DLJ and CSFB was kind of a pivotal point. It was obvious that at DLJ, we had, I don't know, call it 65, 70% of the highest quality place market. It was the golden era. We enjoyed a unique position that hasn't been repeated since. So we had a great post. When the merger occurred with CSFB, it became obvious that it was going to be pushed into even more of a scale game. So it pushed to raise 20, 30 funds at a time. And it changed the dynamic. I mean, Greg and I in the West Coast formed a partnership, which was unusual in the banking industry, where you're kind of commission driven. It was frowned upon by the senior guys of the group, right? Because they wanted this intensive, pointy elbow, competitive orientation. But we said, look, we know we can be more successful doing this together, and we did, and that's the model that we ported into Probitas. But at the end of the day, when the merger became clear post-merger that it was going to be a scale business, most of the relationships we developed on the West Coast with big pensions and foundations and endowments had really become personal. When we showed up, we told them the good, the bad, and the ugly on product. We didn't sell it saying, this is great stuff you got to buy, like most of our competitors. And knowing that volume was going to cause us to change that orientation, we said, look, we think we can do this with more integrity, fewer funds, and still preserve the essence of what we found most attractive about the business, the personal relationships with the institutional investors.
And that's how Probitas was born?
That's how it started.
I always was fascinated with the 2 or 3 of you get together and you have this idea, and you're walking away from something established, something that pays the bills. Just walk me through that time.
Yeah, I mean, the departure was interesting, right? The offer was for significantly more compensation than any of the 3 of us had ever seen before, and may ever see again, to try to preserve that team. And we kept saying, it's not about the money. We want to do our own thing. And they'd say, okay, what if we pay you this much more? So guys, no, that's not what it's about. Look, the 3 of us got together, formed a business plan, really asked each other what was super essential and important to us and what we wanted to accomplish in the next, at that point, decade. We really had some clarity around integrity. I mean, the name wasn't chosen by happenstance. Mm-hmm. We had 50 names that we threw up on a board. Probitas was the first one around my dining room table, probably May, June of 2001. And ultimately, out of frustration, we circled back and ended up changing Probity to Probitas, and said, look, we just have to go make this name mean something because all the others are gone. The early days were unbelievably exciting. Our formal official launch was at 9:30 in the morning at a big real estate conference in New York. And at 9:35, 9/11 happened.
Oh.
And we were devastated in terms of having, at that point, 11 employees. So we had recruited and we had promised people that we would take care of them. They left their jobs and we were left with, a full overhead structure and virtually no possibility for revenue in the near term. So I was in New York and I made it back in 3-4 days. And literally 2 days later, the three of us were back on a plane, flying back out to New York because that's where we needed to get things going because we had a business to get going.
And the business was in New York back then? Because I would assume that right after 9/11, everything just stopped.
It did. I mean, the opportunities were in New York. We were building out our New York office. But at the end of the day, the saving grace, and we had built a business plan that included fundraising, asset management, and the third leg of the stool was secondary intermediation, agenting secondaries, positions in funds that institutions owned. 2001 was still at the edge of the bubble, the tech bubble and the blow up. And a lot of investors weren't able to or didn't want to make their capital calls. So they needed to sell their positions. Mm-hmm. So we evolved very quickly that business. That allowed us, frankly, to survive when most of our other competitors that were starting up new placement enterprises just went out of business. So we built a formidable, we probably had 50-50 market share with another organization then of doing secondaries. And we evolved the technology and created a lot of what today is the current secondary market in terms of processes and structures and strategies. So pretty exciting time, but thankfully that kept the lights on.
How did the industry change since you started the business for both industry for placement agents and private equity?
Well, the secondary side, we ultimately chose to cease our participation in the business. It became less of an advisory consultancy. We can help you manage your portfolio and then sell those things that don't fit as well into a scale game. So when the investment banks entered that market, it was probably a 1.5% fee business for us. And we legitimately added that value at the front end. It was very quietly done. It wasn't high profile in public, and people liked that aspect of it, so there was more value. When big players like UBS came in and migrated the economics to 25 basis points and just speed for execution, it became less interesting to us as a business model. The placement model fundamentally hadn't changed a whole lot. During our DLJ days, most investors needed lots more of everything. So we had a spectacular wind at our back that we enjoyed. And because we had the highest quality product, typically, it was frankly an easier market. It was a pretty fun, exciting market. Today, most of the US market and most of Europe is pretty much to exceptionally mature. So if you're selling a product into an institution today, they probably already have one, unless it's credit, which is kind of the new horizon. But if they have any product today, you've got to displace an existing incumbent, and that means your performance has to be not better, but substantially better to go through the rigors of selling out that position potentially, but more importantly, a whole new diligence process and all the time and effort to build a new relationship. So the bar is especially high. So today, more of the value in the placement advisory business is frankly knowing where not to go, not to waste resource, to be extremely efficient for your fund manager client raising capital, and to have a much better picture of pre-qualification of interest. That's why we spend so much more time, I think, than most of our peers without a client in tow, having one-to-one discussions like this to really understand, where the demand lives for different products.
What are some most memorable deals you guys made, or maybe some memorable clients? I'm sure you want to say all your clients are memorable, but there is always something. Maybe deal went bad or exceptionally well. I'm looking for some interesting memories from your 17 or 18 years as a Probitas.
Look, in our prior lives at banks, all of us collectively have had a number of situations where funds blown up that's been really embarrassing and frustrating. You spend 1.5 2 years raising capital only to have all of your clients invested in asking how it's going, and then it blows up, and it clearly doesn't reflect well on you, right? We have enormous good fortune at Probitas not to have had one of those, which is probably more luck than anything else, to be honest, given we've done about 85 funds. But probably the most memorable, the most exciting is when you find a manager that is going to succeed because they have the special sauce, they have the personality, they have the passion, notwithstanding the strategy and unique attributes and all the fundamentals. Something about them is going to make them succeed. And when I look back at a number of funds where we did essentially first-time funds, the phenomenal group in New York called KPS, which is Wilbur Ross's replacement, in my view, right? They're the dominant killer players in distressed and stressed investing. We took them on when they had $400 million of assets under management. They had one realized deal out of the 8 in their portfolio, and it was a 0. But you could tell that they had something special, their ability to find assets, using labor unions to convert that trust into a side-by-side going into a bankruptcy court to emerge on the other side already in the money and then drive value beyond. So today they're the tallest giant in that space and well earned. But they started from pretty modest beginnings, and we had faith and confidence in them. And it was early in our franchise. They had faith and confidence in us and gave us the opportunity. Another group like that is probably KSL. People would know them from Squaw and Alpine, Deer Valley, and a bunch of ski resorts that they bought. But they're a broad travel and leisure player that we helped spin out of KKR. They had aspirations to go take on this new travel and leisure space, which was not defined before. We helped them raise several funds, helped them raise a credit fund. And again, today, they're by far the giant in the travel and leisure space on the PE side, amassing ski assets side by side to compete head to head with Vail. It's exciting and interesting when you see where they came from and you see where they've now ended up. And we've got, a dozen stories like that from early stage investors that we help put in business.
It's fantastic. So what is Probitas now, and where are you guys going?
Hand on the rudder, keeping things steady because the business continues to be interesting. I think we've got to be nimble on structure. We're always nimble on strategy, so things evolve. But if you looked at our book 4 or 5 years ago, it was 65% real estate. Today, that's pretty moderated, right? Because the appetite for those funds at the peak of the cycle is modest. We're looking at direct real estate because there's a huge migration for investors to not invest only in funds or to invest in direct or co-investment structures, especially family offices, which have become a new big capital base in our world. I think it's going to be, more of the same, right? We're reactive to the market and to what investor demands are. We adjust our product offering and how we operate accordingly. But I think it's going to be more of the same.
But you have several offices, right? Not just San Francisco and New York. There are some international. Is it correct?
Yeah, absolutely. London and Hong Kong. And I spend a considerable amount of my time in those offices. Europe is almost the renaissance and resurgence of new capital. Family offices, insurance companies, consolidating UK pensions. I mean, the landscape of capital markets in our world changes a lot. And today, the Germanic-speaking market in Europe is an especially exciting new place for new capital that makes it really exciting to play. Some of the Nordic funds are getting substantially new allocations for private equity that'll revitalize what were mature programs into being younger programs again. So Europe itself is very exciting, and the quality of the managers, now that there's more performance data to prove up, and now succession happening there too, just like here, is spawning all kinds of new and interesting funds. Credit, like I said, is new across the board. So credit managers doing illiquid funds like what we raise in interesting strategies there are popping out of the woodwork. So the direct lending game is kind of consolidating and almost done in the course of 5 years with big $4, $5, $6 billion funds. But that's generating 9-10% returns. It doesn't fall into our alternative world typically, but the rest of the credit world is a really exciting place where it's still pretty wide open. Probably the most exciting market, obviously, is Asia, right? If you look at the daunting amount of potential capital, even if you looked at only the 20 largest insurance companies out of China, all of whom want to get instant exposure as soon as the currency constraints come down, that's like another QE for another 5 to 10 years potentially. I mean, crazy numbers. But that market is becoming more mature. Rather than investing only in the big guys, they're investing in middle market. So they're becoming a viable market for the kinds of products that we typically take. And at the same time, again, maturity of track record and performance is yielding some really attractive, interesting fund managers and a bunch of spinouts from what were typically a bunch of U.S. global funds set up Asia funds, and these guys all have entrepreneurial aspirations. So we're in dialogue with lots of those startup funds, kind of like the U.S. 15 years ago.
Seems like we'll learn a thing or two about Probitas, so thank you very much for that. I have a little blitz for you, Michael. I wanted to learn some of your favorite things. I'm going to ask you a question, and you just quickly give me an answer. One word is okay.
Okay.
What's your favorite movie?
Independence Day.
Favorite movie star?
Tom Cruise.
Favorite singer or band?
John Mayer.
Favorite song?
It's his, right? Run through the halls of your high school, right?
Do you want to sing it?
No. You don't want me to sing it.
What's your favorite book?
Really wacky. Probably Ulysses.
Your favorite sports?
The Warriors, basketball.
What's your favorite place in Bay Area?
Hiking around the top of Mount Tam.
And your favorite country to visit?
For relaxation or business?
I'll leave it to you.
Who cares about business?
Exactly.
Relaxing. Thailand.
Who's your favorite historical figure?
Probably Reagan.
And what's your favorite quote, if you have one?
The recent first lady who passed, Barbara Bush, right? No one will ever look back on their life and regret not spending more time with their kids, their colleagues, and things that are important.
That's deep. So the final question, what life advice would you give to young people today?
Ooh, that's a tough one. Look, I'm challenged. Everyone pokes at the millennial generation, and I think there's an expectation set that a lot of us as parents have kind of helped to create, so we're as responsible for the outcome as the participants. Careers don't come easy, right? Opportunities are sporadic, and especially in a place like the Bay Area where it looks like opportunity is easy and things are up and to the right. You got to put in your time. You got to learn it. You got to get the benefit of mentorship from people that have been there before, so that you have not just experience, but ultimately wisdom at the end of the day. And that doesn't come any way other than putting in the time. So, find people that you like and respect that can help you on your career path. But flip side, give them the benefit of true time and effort in support of that. And then at the end of the day, pick where you want to live and be happy, and figure out how you're going to stay there instead of the other way around. My quadriplegic master professor, that was his number one point of advice, and it took me 30 years to figure out why he was so right.
That's fantastic. Thank you very much, Michael. It was a pleasure speaking with you.
My pleasure. Thanks.
Thank you for listening to The Accent Podcast. For more episodes, please visit theaccentpodcast.com. Until next time.